The oil market has been going through a rough patch lately. The mainstream media is full of headlines about record oil supplies in 2026, weakening prices, limited demand, and a growing surplus. No wonder prices have dropped sharply. But is it really that bad? Or maybe it's a rare opportunity to profit from hated but cheap oil sector? Let's find out. But first, what is the real price of oil? The dollar price doesn't reflect reality. The dollar has been weakening for a long time. US dollar has lost more than a half of its purchasing power over the last 30 years due to inflation. Gold, copper, and silver have gone up significantly, but oil hasn't. We get the best picture when we look at the current oil price expressed in gold, the real money. As you can see, oil is currently the cheapest since the pandemic, and almost the cheapest in history, at least since 1950. I've rarely seen such good opportunity in oil. Oil equities globally are undervalued because of the political and social environment. Some believe that humanity will reach peak oil demand in 2030 as a consequence of decarbonization efforts. Well, this is a false assumption. Why? Oil is the basis of modern civilization. It powers not only cars but also ships and airplanes, serves as fuel for electricity production, and is used in the petrochemical industry. I like the possibilities of the energy transition and critical minerals narrative for copper and other stocks, but I do not believe oil and gas will disappear anytime soon. Emerging markets' carbon consumption per capita is 1/4 of what carbon consumption per capita is in the West. The cuts in carbon consumption will take place almost exclusively in the West, and they will be rather moderate. Consumption in developing markets is expected to grow. The growth will be driven mainly by countries in Asia and Africa, with India at the forefront. No matter whether we take the IEA or OPEC report, both show more or less the same. Also, if we want to see decarbonization effects in the West, it's best to take a look at Germany, a country whose energy supply went from stable and secure to unstable and expensive, and where power bills have increased significantly. For this reason, I don't believe that the decarbonization targets will be met at all, and that oil use will continue. According to OPEC Secretary Haitham Al-Ghais, there is no peak oil demand on the horizon. OPEC projects oil demand rising 19% to 123 million barrels per day by 2050, led by India and Africa. The forecast contrasts sharply with International Energy Agency projections of demand peaking by 2030. Global economic development with growing demand for oil and an increasing global population and middle class are set to underpin demand growth in the coming decades. Moreover, oil demand will also be supported by U.S. President Donald Trump's exit from the Paris Agreement, resulting in higher demand for hydrocarbons in general, and oil and gas in particular. Oil prices are low also due to global oil market projections of a massive surplus in 2026. Especially the International Energy Agency and major financial institutions warned of a deep market surplus by the first quarter of 2026, but current market data suggests a far more balanced reality. Meanwhile, the International Energy Agency has cut oversupply outlook as winter disruptions curbed output, with global supply shrinking by about 1.2 million barrels per day. According to energy expert Dr. Anas Al-Haji, all this surplus predictions may be based on fundamental accounting errors and a misunderstanding of geopolitical trade shifts. Forecasts suggesting oil prices would collapse into the $40 range have repeatedly failed to materialize. Despite persistent warnings of a glut since early 2025, Brent crude has remained steady in the $60 to $65 range. Al-Haji notes that institutional forecasts have a long history of inaccuracy regarding consumption trends. If you look at the IEA forecasts, they've been for growth in oil demand, They've been wrong every year for the last 18 years, Al-Haji stated. He argues that these agencies consistently underestimate demand while exaggerating the impact of oil on water, crude currently in transit. Distorted data, shifting routes. The narrative of an oversupplied market is often skewed by a failure to account for longer shipping distances. For example, Brazil has shifted its exports from the US and Europe to China. Because the distance to China is triple that of previous routes, more oil remains on water for longer periods, appearing as an increase in inventory even though the actual supply has decreased. Similar distortions appear in North America. Canadian oil previously moved through U.S. pipelines and was not counted as oil on water. With new pipelines to the West Coast now sending 400,000 barrels a day to China, analysts are counting this as extra supply rather than a simple shift in transportation mode. But even if there is a slight oversupply this year, it does not change the fact that the long-term prospects for oil are simply wonderful. Okay, let's go back to the chart of oil prices expressed in gold. Even if nominally the price of oil has recently increased, the real price, priced in gold, is on the lowest levels in history. It's the single most powerful signal I've ever seen in the oil market. Quoting the famous natural resources investor Rick Rule, "In resources, you are either a contrarian or a victim." Well, I think this is a right time to be a contrarian. In my opinion, the best way to take advantage of this situation is to invest in oil stocks. In case of the negative trend reversal, these companies will gain the most due to the potential for improved results when oil prices rise. There are many good, reasonable-priced companies on the market, with major producers like ExxonMobil, Chevron, or Occidental Petroleum in the U.S., CNQ or Tourmaline in Canada, or Aker BP and Equinor in Norway. For broader exposure on oil sector, investors can use one of the many ETFs, like Vanguard Energy Index Fund or iShares Global Energy. This video is not intended to analyze specific companies, but to highlight the extremely negative sentiment in the oil market and the potential it brings. Global oil demand continues to rise, leading to a renewed focus on oil and gas. It is possible that we are at the beginning of the next oil supercycle, driven by structural underinvestment, geopolitical tensions, and stalled energy transition plans. Of course, it may still be too early. The near-term forecasts for 2026 suggest lower prices due to oversupply, but long-term prospects are more than good. After all, it's better to be a little too early than too late. For patient investors, this could be a good opportunity to buy and wait, especially since many oil companies pay decent dividends that will sweeten temporary price drops. Some of them pay 4 or even 6% dividends. That's not bad to hold and wait. Thanks for watching. If you liked it, subscribe.